Kerry Boulton is Australia's most respected exit strategy advisor and CEO of the Exit Strategy Group. Welcome to this week's segment.
So another obvious exit strategy is selling to a third party. And this type of sale can take very many forms and a variety of terms and conditions. You could find a buyer who's a competitor, you could find a buyer who's a customer, a supplier, you could be in the same industry, and those are strategic buyers. Alternatively, you could find a financial buyer, such as a private equity group or a hedge fund or perhaps an institutional investor, or maybe just simply a personal buyer who wants to actually get into the business that you have. It's really, really important to understand what the buyer's objectives are when they're looking at your business and why they really want to buy the business. It's as important for you to do your own due diligence on the buyer as it is for the buyer to do the due diligence on your business, because different buyer motives will affect the business, and it may be something that doesn't fit with your own personal and business goals and objectives. For instance, a financial buyer might be the best fit for you if you want to liquidate your investment in the business while staying involved in a management capacity. However, remember, the time horizon for growth and cashing out may be at odds with your personal objectives, so you've got to make sure that they fit together with one another. A strategic buyer, for instance, could also offer you a partnership type of solution, which allows you to cash out at least part of your investment. And this type of buyer could be the one that you really need if you have a specific business goal that you're unable to achieve on your own. So once again, if you're a well-prepared business, that may well be the best way for you to cash out and achieve multiple business and personal goals. So what would be the advantages of being able to sell out to a third party? First of all, the fundamental advantage is that you will in fact receive a majority of the purchase price in cash at closing, assuming you've negotiated that, of course. This type of exit strategy also typically results in the highest valuation for a business because you have natural market forces at play, and in any natural market, you're going to be able to find the best result for yourself. The price that you can obtain from a third party is more likely to be equal to the fair market value of the company, if not more. And a third-party sale is the only exit option that offers you the potential of access to buyers with a strategic or synergistic motive, leading to a sale at a premium to fair market value in a strategic sale. And it may well be the best option for a business that's too valuable to be purchased by someone in the family, for instance. So you really do have to look to the external marketplace. And a large variety of available buyers makes it possible for you to find a buyer who will allow you to satisfy your exit needs. And relating to some of the soft issues that are involved, such as time, in addition to the money issues. So you can negotiate the right sort of exit for yourself depending on your own goals. So what's the downside? What would be the disadvantages of selling to a third party? If you want to stay on after a sale to a third party, you will find yourself in the role as an employee, which can be very difficult to handle. In other words, top banana one day and you're down to the bottom of the fruit bowl with some of the rotting fruit the next day. That can be difficult to handle from a personal perspective. Sometimes third-party buyers will need you to actually finance a portion of their purchase price with a note or an earn-out structure. And, that could be difficult if you're no longer in control of the company and you're not able to make decisions that are actually going to be controlling the company's future growth. It depends on the planning that's been done and obviously the discussions that you've had in terms of your negotiation. Selling to a third party can often take a long time. It could be 9 to 12 months for it to actually execute. And it could also result in a loss of customers and employees if confidentiality is not well managed. It can be a significant hurdle to overcome, and it's one of those issues that you really do need to take into account when you make a decision to sell your business. Another exit strategy is going public, often referred to as IPO, initial public offering. And really, this can be the ultimate exit strategy. There's no doubt that going public is a very exciting and very successful exit strategy for many entrepreneurs, business owners. However, a very small percentage of private companies can ever go public. You really need to be in the vicinity of a $50 million business, probably as a minimum, to even consider going public. And for all its strengths, it has a number of significant weaknesses that a lot of owners are unaware of. And going public is not really a realistic option, as I said earlier, for the vast majority of private businesses. And it very much depends on market conditions and investing trends. So what are the advantages? Let's have a look at those. Going public does provide you with additional capital to help fund a company's growth. And almost all companies primarily go public because they need money. So a typical IPO raises capital from 10 to 40 million perhaps, but offerings up to 100 million aren't unusual either. I'm sure you've seen many offerings out there with large prospectus and whatever the listing price might be. It does create significant liquidity for you and your key managers and other employees if they happen to have an opportunity to get in on the ground floor. Going public does give you a higher profile than any private firm, and it's important in industries where success requires customers or clients to make long-term commitments. Many, many big companies prefer to work with public companies because the public stature creates a sense of security. So you're not a mum and dad shop, so to speak, who might not be around tomorrow. Many government contracts rely on businesses that are of a significant size just to make certain that they're going to be around for the future to be able to deliver on those contracts, for instance. It does help to be able to offer employees shares that are actually liquid, whereas in a private company, you really have an illiquid market. But when you're in a public company, you have shares that you can actually sell on the stock market, and that will improve a company's ability to be able to attract key management as well. And of course, valuation multiples of public companies are generally significantly higher than multiples paid for smaller private companies. It follows that the bigger the business, the higher the multiple that you'll receive. So it's worthwhile considering that when you're thinking of your own growth strategy as well. Now let's have a look at the negative side. What would be the disadvantages if you're thinking about going public? As I said earlier, it's not available as an exit option for most owners of private companies. It's really only typically available for high growth companies with significant revenues and earnings. So it will mean diluting your own ownership. If you're sitting on a gold mine, it means that all the future gold will be shared with new shareholders. However, if the price is right, it may well be worth it. Having 15% of a $150 million company as opposed to 100% of a $10 million company is an entirely different proposition. So diluting your shareholdings may not necessarily be the huge disadvantage that it's perceived to be at the outset, but it will mean your shareholding will be diluted. So a public company is naturally no longer private. So you're going to be giving up a great deal of privacy. After you go public, you have to file a number of regulatory reports, the tax office and with the stock exchange, and you have to comply with certain security laws and all the exchange guidelines, and all the disclosure that can be required can be quite disconcerting if you've been a private company for a long time and you don't quite know what you're in for in terms of the information that you have to make available. And of course, you might also tell your competitors a lot about your business that you were able to keep private before. And going public typically means a loss of control for you personally, the business owner. And in fact, investors can buy a significant stake in the company to actually take control and fire the founder. I'm sure you've heard of cases like that in the past where the CEOs have been thrown out by the shareholders because they've just not been happy with the way things have been going. And, of course, an IPO is a very costly undertaking. Typically, you'd be spending 15 to 25% of the money that's actually raised on direct expenses. You wouldn't be able to go public to list a company for anything under $250,000, and that's not very significant. You'd be looking at a lot more money than that usually to be able to go public. And so the opportunity costs of doing something like that in terms of management time can really have a significant effect on the business. And going public doesn't necessarily provide existing shareholders with immediate liquidity. Quite often, the process of going public requires that the business owners have to hold on to their shares for a specific length of time, and they're locked into that for 12 months, 2 years, sometimes even longer following the IPO. So you're not necessarily going to have your liquidity straight away. Notwithstanding all of that, if your business is of a size that you could consider going public, then it's definitely worthwhile thinking about it.
If you don't have a copy of Kerry's new book, The Uncensored Truth About Exit Strategies, please visit freeexitstrategybook.com.au.